Today we're going to talk a little bit about equalization of net family property, or what most people refer to as division of property. I want to stress that it's really important that you educate yourself. I'm going to give you general principles today, but as you will see, this is a really complicated area, and you really do need to see a lawyer to speak about your specific situation and get the proper information as it pertains to you as an individual. There is a general misconception that when you separate, you have a right in your spouse's specific asset, or you might be responsible for your spouse's debt. That's not the case. The first principle is we look at assets and debts based on ownership. And by ownership, I mean whose name are the specific assets and debts in. The law in Ontario takes a much more wider or global approach than looking at each asset or debt individually and dividing them. You will see that this creates a calculation at the end of the day, which I will explain in more detail, whereby someone owes someone else a sum of money, but it's not necessarily that the assets or debts are going to be transferred to you that belong to your spouse. This regime only applies at this point in time to married spouses. It's only married spouses that are entitled to share in the net worth growth of their spouses. In order to look at this, what we do is we look at assets and debts of each spouse based on ownership as of two very specific points in time. And what you need to remember is we're looking at date of marriage and date of separation. A lot of people will get confused because when we ask, what did you have on the date you walked down the aisle? They will say, well, I had a bank account, but I got rid of that during the marriage. It doesn't matter what happened to it during the marriage. What you have to remember is to freeze time as of the date of marriage, the date you're walking down that aisle, and the date you separated. It'll make it a lot easier conceptually to figure out what kind of information you have to provide to your lawyer, what kind of information goes into this calculation if you think about it that way. What we're doing and why we're freezing time on the date of marriage and date of separation is we're measuring how much you as an individual, how much did your net worth grow during those two very specific points in time. We do the same thing for your spouse, and at the end of the day we compare those two numbers, or the growth in both of your assets minus debts. So for example, just to make it clear, if your net worth grew $100,000 during the marriage, so you're up here, and your spouse's pile, or their net worth, grew to $50,000 during the marriage, you've obviously got unequal piles that accumulated during the marriage. What the law in Ontario says is that marriage is a partnership, therefore you can't walk away with unequal piles or unequal net worth growth. What happens is those have to be equalized. That's what we call equalization of net family property. So, very simple terms, if one pile is at 100 and one pile is at 50, the pile with 100 has to transfer over 25,000 so that this pile comes up to 75,000 and this pile goes down to 75,000. You've obviously then got equal net worth growths, or equal piles, and that's how the law operates. In terms of the equalization of net family property, the one other important thing to remember is, as I said at the beginning, assets and debts registered in your name or your spouse's name remain your asset or debt unless you're using it to satisfy the actual equalization payment that you owe. One thing to have in mind is normally you can deduct the value of your assets you owned as of the date of marriage, and this is why we do freeze time as the date of marriage and deduct that from the date of separation. One thing that's treated slightly differently, or a lot differently in this instance, is a matrimonial home. That, because it's a matrimonial home, the legislation provides that there's specific differences that attach to it as a matrimonial home. If you own a matrimonial home on the date of marriage, or you own a home on the date of marriage that subsequently becomes a matrimonial home, under the rules that I just told you about, normally you would get to deduct the value of that home coming into the marriage. Unfortunately, however, if that home is still a matrimonial home on the date of separation, you lose that deduction and you actually have to include the total value of that house in the calculation. If it's disposed of prior to the date of separation, then you do get the deduction. There are some exclusions when we're calculating net family properties. These can include things like inheritances, provided that you've kept them separate and they still exist in some form or another on the date of separation. Other things that can be excluded are gifts given to you by third parties other than your spouse or ex-spouse. And again, those have been kept separate and still exist. Also, you can look at personal injury damages. They may be able to be excluded. It's a little bit more of a complicated area, and again, you should be looking to a lawyer to assist you with this issue. There are some very narrow exceptions to the equalization of net family property. The legislation does provide that if you've been married for under 5 years, you may be successful in seeking an unequal division of net family property. So what I've just told you about would not apply. And in addition, if your spouse has recklessly depleted marital property, you may be able to ask for an unequal division of net family property on the basis that obviously it's not just to have this equalization in that instance. For example, in terms of recklessly depleting property, sometimes someone may have a gambling issue or may have intentionally tried to deplete assets in preparation for separation. Again, complicated issues that you need to specifically address with a lawyer.